Hi, everyone, and welcome to our first quarter 2025 market update. It's just after Easter, so I hope everyone had a nice Easter and a nice Passover. So we've got quite a lot going on, Christian. Thanks for joining us. You put together a lot of charts and graphs to take us through what we think are probably the most important items to look at. But it's been quite a busy beginning of the year, hasn't it?
Yeah, it feels like we've gotten a few years of news in the span of a few months, if we're being quite honest.
Yeah, so we're all aging gracefully, right? Anyway, okay, so why don't we dive right in and we'll start with the fun stuff, which is a word from our lawyers. That always is where we begin. So, 2 out of 3 dentists agree, and objects are closer than they appear, and your mileage may vary. Moving on.
And
Okay.
moving on, so we like to start these calls with a broad overview. And so I've updated this data as of the end of last week, so the returns are recent. And as we're all likely aware, and we just kind of alluded to it, it was a very turbulent first 3 months and change for equity markets. And despite the negative bias that we've seen kind of permeate U.S. equity markets year to date, a few areas of the market did hold their own. And these are a few areas that we actually touched on coming into the year and through our recent commentary as areas that we thought added some protection against some tariff-related uncertainty, but also still some earnings momentum. And so healthcare, consumer staples, utilities, two of those actually finished positive. Healthcare finished marginally negative for the last quarter and change. Areas that did not perform well were tariff-sensitive sectors and the Mag 7, which we're going to touch on in more detail.
Yeah, very
But
important.
those really drove significant weakness across the consumer discretionary, technology, and communication services segments. So yes, a turbulent first few months, a negative first few months in equity markets, but it wasn't all negative, and we're going to get to that in just a second.
Yeah, and I think it's important we highlight that. And when we get into the Mag 7, we'll see even more of it. That, when people look on TV and they see that the market is down, it's like, well, it's not all of it. So, I think that's where we're able to add a lot of value in our portfolios is by trying to stay out of the stuff that's getting clobbered and, staying in the things that are still performing well. And again, we talked previously about, focusing on the trends that are enduring but I'm getting ahead of myself. I'm sorry. Okay, go to the next one.
Yeah, all good. So a quick word on valuation. I think, when we spoke coming into the year, certainly this is an area that we recognized as a point of potential caution. We recognize that multiples of the S&P 500 were certainly more elevated than they had been in the past. And we felt that any future performance would have to come from positive earnings revisions. With recent policy announcements more akin to kind of shooting oneself in the foot, multiples have contracted across the board, but do remain above historical averages. If we just take a look to the chart on the right here, the largest contraction that we've seen across multiples were in the top 10 stocks of the S&P 500. They were contracted of over 5 turns. The rest of the S&P 500, excluding those 10 stocks, contracted about 2 turns through this recent drawdown. And so that really is a highlight of the concentration risk that we've been talking about in U.S. equity markets. So,
Yeah, and
Darren,
we've been on
yes, sir.
this for a long time about how I use that analogy of it's like a toddler with a big head, and they kind of everywhere they go.
Yeah.
And we've been talking about this. We've been very cautious on in our portfolios to not chase the winners, and I'm sad for people that didn't listen to that and may have dove in and bought Nvidia at the top and all these other stocks right at the top because, as we can see in the tariff war and everything else has happened, they've given the most back. And so when we look at how the index is constructed, the thing you watch on television, it might be down a lot, but it's really, and it went up a lot, but it was really just that a group of 7 or 8 stocks went up the most. They've come down the most. Whereas everything else has been, pretty meh. It hasn't been phenomenal. So we were right not to chase it up and not get clobbered on the way back down.
Yeah, exactly.
Now some of these are actually quite interesting, I think, to actually buy. I think that some of this froth might have come off of some of these.
Yeah, exactly that. And I think this is really an environment where we continue to reiterate the importance of remaining active in our portfolios and being diversified away from some of the concentration risks that we were seeing. You likened it, you spoke about toddler's head. You also likened it to an elastic band, and eventually it becomes so stretched that the snapback is quite violent. And so, the Mag 7 represents 66% of the negative equity market returns year to date. And we can see on the chart here, it's quite predominant, the disparity between Mag 7 drawdown and the S&P 500. And there are a few reasons for that, and we're going to get into it. in just a little bit.
Before we do, I just want to
Yeah, go ahead.
comment on that. And I think it's really important people understand what our primary function is, which is to manage risk. If and because I meet other advisors that are out there, they're trying to be performance chasers and performance centers. And I think the problem when you're focused on performance only is that the way you do really well if you're focused on performance is just buy the index with leverage. And you'll do better than the index because of the leverage, but you're going to magnify the highs and the lows in a way that like no one will keep their head and arms inside the ride. So that's the problem, is that if you want to really chase the up, you've also got to put up with really aggressive downs. And I think what we try to do is to keep that longer term return, which is more on target to what people's requirements are, as Ryan and Carolina do their financial planning, is give people the highest odds of success of reaching their goals, which is to clip out those highs and those lows and try and get a really good return kind of in the middle of that. And the way you do that is by avoiding these excesses in both directions. So I just want to point that out, that we really are risk managers as opposed to performance chasers.
Yep. And so speaking about managing risks, coming into the year, we highlighted our expectations for more elevated volatility than what we've seen. And that was something that we had a lot of confidence in, given the range of factors that we expected were going to impact markets. So we had not only just Trump, we had monetary policy, we had inflation fears, we had remaining geopolitical conflicts. So there's real confluence of factors coming into the year that we felt would lead to more volatility in equity markets. And we've seen that year to date. Volatility spiked significantly on the date of tariff announcements and has settled at an even higher level after that. And volatility has been historically negatively correlated to equity market returns. And so, yes, volatility is certainly heightened, and the uncertainty that's kind of permeated markets has been heightened. We're going to get to that in a lot more detail. And we're going to have additional slides even at the end of our chart packet here when we speak about volatility and dealing with uncertainty. But as a precursor to that, we can see on the chart on the right here that single name volatility and drawdowns are a predominant feature of markets. So when we reiterate the importance of remaining prudently diversified, it is because of these charts here that we reiterate that point. And so when we talked coming into the year, and just kind of a reflection of our initial year outlook and how we're doing year to date, a real notable divergence has been European equity performance, which certainly goes against broad consensus coming into the year and our thinking, which did evolve through the quarter, and we're going to explain that. But the returns of European equities were equally matched by improving sentiment prior to the tariff announcement. And so that really reflected growing optimism for the region versus its global counterparts, and that was right up until Liberation Day. So European equities, it's changing a little bit. We've seen that in the return profile. We're going to get to our thoughts on that and how that evolved. But let's talk about Liberation Day. So certainly it surprised financial markets. The average effective tariff rate, which has fluctuated a little bit given recent policy changes, was certainly significantly higher than was expected by market participants. If you've been following our commentary, tariffs, in spite of them being used in some cases as a bargaining chip, have been taken very seriously by the team. Yep. Now, news seems to change every day, and we're at the whim of a man and his Truth social media account. Therefore, we can really only evaluate what we do know at this time, and it's consistent with what Darren and I have reiterated in our recent commentary in the past. So what is that we do know? So one is tariffs are inefficient. We do know that. The ultimate effect of tariffs could be inflationary at first, and then deflationary over time as consumers are unable to spend across the same volume of goods and services. Likewise, we still do not, and quite frankly will not know the duration of these tariffs, counter tariffs, and additional retaliatory measures that could come to fruition. And so we encourage you really to take a look at the pieces recently published by Darren and myself in respect of how we're dealing and being active across our portfolios and insulating from these known risks. So there are a lot of unknowns at this time. What we do know is that the damage to growth from the uncertainty around tariffs can be just as detrimental as the tariffs themselves. And so as tariffs continue to disrupt global economies, it will negatively impact growth if they continue to remain in place. What we're also seeing, and this has been a big change, is that tariffs have really galvanized foreign markets to retreat capital away
Yeah.
from the US. So through history, and I do like my history analogy, so just bear with me for a minute. But through history, we've seen countries try to fight a war on multiple fronts. We saw it with Germany in World War I and World War II. We saw it through the Napoleonic Wars. And ultimately, those were all unsuccessful for the aggressor. So while the impact of tariffs on a country for country basis is relatively better for the closed economy of the US, the combined impact of these actions across the global economy relative to the US is detrimental. Now, in spite of all that, there is a silver lining, and I kind of alluded it to in my opening comments here, and that is trade deals can come to fruition and tariffs
Mhm.
can be as quickly removed as they were put on. And while a trade deal with China is likely further away due to national security interests, it is ultimately likely that a resolution is going to be at a lower level than what we're seeing today. And so, just to reiterate our stance here quickly before I pass it off to Darren for a few comments as well, we are taking and have taken the potential impact of tariffs seriously. I hope that's come through in our commentary, but also in the changes that you've seen in our portfolios. It is an uncertain and ever changing environment, but we've been very proactive in evaluating our risk exposures, changing our asset allocation where it's been warranted, raising liquidity where needed, and we're ever active now in trying to identify opportunity amidst this dislocation. Because as you like to say, Darren, we love to find a bargain.
Yeah, and we're getting them, right. So this turbulence is certainly creating it. We're down again in the markets today, and these are actually the times where, when you look back on the chart, this is when you're supposed to go shopping. So that's what we're in the midst of doing. With respect to Trump, I think a couple of things. First of all, he's not elected to be the president of Canada or the president of Britain or the president of France. To be the president of the United States. So he's obviously looking after the American citizens in the way that he feels is the way to do it. We'll see ultimately if it is ultimately good or not. That we'll see. I think I made the comment before that we don't do panic here, so we're not rushing around trying to figure out which way the wind's going to blow, because I think we all know it doesn't work like that, especially with President Trump. And I've read The Art of the Deal, and I would say more politicians and business owners probably should, because it's no surprise that he comes in the room, he kicks over all the furniture, and a lot of things he's doing are straight out of the book, right? About using your leverage and asking for all this stuff. So this isn't a surprise. So trying to figure it out, we'll see it when it's done. But I do think there's a huge opportunity for other countries like Canada to really focus on how do we become more competitive. I think Canada's not done a great job. And that's actually what our election is all about in Canada is, what view of the future do we want? And I think what President Trump has done is demonstrate, at least for our country and a lot of others, maybe we haven't been as good trade partners as we could have been. Maybe we need to fix some of our own internal problems to be more competitive and not reliant on things as they were, but maybe focus on things as they could be. So, okay. Otherwise, I'm going to drift very quickly into the political stuff, and I'm going to get in trouble. So,
But
okay.
it's actually a great connector to our next slide here, Darren, and that is revisiting Europe.
Yeah.
And so it's an area that we revisited extensively following the German elections and recent economic events, and we decided in our multi-asset portfolios to allocate more fully to move towards a more neutral global asset allocation stance. So when we talked about Europe coming here, we highlighted a few of the structural problems, and yes, those are likely to remain in Europe. But on a cyclical horizon, we are seeing some relative improvements now to the European backdrop. So global growth impacts from tariffs and policy uncertainty will impact Europe on an absolute basis because they are a relatively open and pro-cyclical economy. And I'll have a slide on that next. And we've talked about it in the past. However, Darren, you just spoke to this just now. What's happened through Trump's tariff is really a reinvigoration of fiscal appetite in Germany after years of suppression. And we see on the chart on the right here that relative fiscal policy is correlated to relative stock performance. So we now have Germany, who's increasing their fiscal appetite against US, which
Yep.
is being more tight in their fiscal policies. We also have relative equity risk premium and valuation still working in the European equities' favors. And so this gives us some increased confidence for European equity relative performance over a cyclical horizon. The European consumer and financial system has also undergone pretty significant deleveraging over the last decade, and so they remain in a pretty healthy place. And as we just spoke to as well, we're seeing financial market participants increase capital flows outside of the US. And so, given the uncertainty that Trump has caused with his global trading partners, we're going to watch closely to see if this capital flow is a durable trend.
Yeah,
So, that's a change.
Captain Chaos has made everybody decide maybe we should be seeing other people. So, like,
Exactly that.
ultimately, this actually could be very good if people wake up and sees this as an opportunity to improve their own standing, to become more competitive, to have better trading relationships. So we'll see. I'm always optimistic, but rationally so.
Yeah. And just as a balance to our counterpoint and why we're moving towards neutral and not completely pounding the table with European equity exposure, we're still very cognizant of the tariff risk to Europe. As I mentioned, relatively open economy. They do rely on U.S. imports to fuel their GDP growth. The job picture there is not quite as rosy, with openings continuing to decline, so labor demand continues to slow. And the fiscal situation in the EU remains quite fragmented. So Germany is the largest contributor to EU growth, but other economies in the EU, such as France, still have a pretty horrific debt picture and are fiscally constrained. So that's our thoughts on Europe, which again have evolved quite considerably over the quarter because the facts have evolved.
Yep.
And we've taken those facts in and we've evaluated them over a longer term horizon. And that's allowed us to make changes that we think are going to be positive to our portfolios.
And if the facts change, we'll change again.
Exactly that. And so we talk now against the rest of the world. So let's talk about the US. So when we came into the year, our expectation was that core inflation had a downward bias coming into the year. It was not as much of a concern for us at that time. And we've seen that come to fruition through the first few months. So core inflation has come down. Inflation expectations on the long end have remained fairly well anchored. But on the short end, inflation expectations are beginning to tick up. And so that's really
part of that's because tariffs will increase the price of things, right?
well, exactly that.
That's
So
the point.
tariff-related uncertainty has caused inflation expectations in the short run to increase. And really, the inflation picture in the US, from our point of view, right now is going to be driven predominantly by what happens, the ultimate outcome with tariffs. And so while there may be one-time price increases from tariffs, there could also be more permanent, non-transitory risks from tariffs. And that because there's supply chains that become disconfigured over time, and that could result in price increases. And Chair Powell highlighted a few of these instances in his recent commentary. So we're going to closely watch that unfold. But in conjunction with rising short-end inflation expectations and increased uncertainty, we have seen pretty significant volatility in yields as markets grapple with federal rate cut expectations for this coming year. And Fed Chair Powell came out late last week and had a conference. And it's pretty evident at this time, in our view, that the Fed does not want to prematurely cut rates into a possible tariff-related inflationary backdrop. And so they're going to have to be very closely balancing its dual mandate of maximum unemployment and stable prices. So our bet is that until we have a clear deterioration in the economic data and employment picture, the Fed will choose to be patient and observe any price increases from tariffs.
Now, an outside idea here is that stance from Chairman Powell could get him fired. Because part of my belief is that if you want to make any sense out of what some of the tariffs are doing, is it's not just about resetting trading relationships, but I do think that Trump is being very mindful of the amount of debt the U.S. has that's rolling over in 2025. There's about $9 trillion, excuse me, that's rolling over between now and the summertime. And the U.S. is about 36 trillion. So this is a pretty sizable portion of their debt. And any basis point drop in interest rates is billions of dollars in savings. So I do have this crazy idea. And by the way, I'm not alone. I used to think I was the only person, but I'm seeing other people talking about this now, that maybe, because the president can't influence interest rates directly. That's the job of the Bank of the Federal Reserve. But if he crashes the car, and causes a recession and everything else, this is the crazy thinking, is that, that would cause the Feds to drop interest rates, because that's what they've done since 1987. Every time there's a crisis, they lower interest rates. So if you want to get interest rates down and you can't control interest rates, you just put the car in the ditch and maybe they show up with the tow truck. And so that's part of what I think might be going on, is that President Trump is trying to get interest rates down, and even if in the short term it scratches the paint, if he can get a much lower cost of borrowing, so if his interest rates came down by 1%, that's billions of dollars in savings over decades, then that could have a very long-term positive influence. Because otherwise, the rate at which U.S. debt, and every other country's got a similar problem, but the U.S. numbers are so gigantic. If they don't get their arms around the debt costs, and they're certainly not spending less, the amount of money that goes to the annual budget to pay interest is just going to become alarmingly large.
Right.
In the last from 2021 to 2023, I should find the number from at the Global Top Advisors Conference. They had some of these charts. The amount that it's jumped in just 3 or 4 years is astonishing. So if you go back and look at what happens with compound interest, it kind of gets away from you, and that's where some of this stuff is going to. So anyway, so I have a feeling that if the Fed wants to be measured, that may not help out the long-term debt problem, but we'll see. This is all just, we're trying to figure it out.
Exactly that, Darren. And we've kind of spoken to the unsustainability of the U.S. fiscal path. And as much as Doge helps on the margins, the core picture of U.S. fiscal spending is Medicare and Social Security.
All entitlements.
And it's going to continue to rise. So that
as our former Prime Minister Chrétien said, I am entitled to my entitlements.
Exactly that. So there's going to be some reckoning needed, certainly, in the U.S. fiscal picture, and we'll see how Trump and his advisors will manage that. Quickly on the U.S. labor market, when we speak about the growth backdrop, we are still going to focus on the employment picture because coming into the year, we kind of highlighted that this is going to be the primary driver of year-ahead consumption. And we continue to see signs of slowing labor demand. And while this is not fed through in claims data yet, we're pretty cognizant of the risks that contracting labor demand could have on employment, which will in turn feed through to consumption. So still very much a flashing yellow light, and we're going to watch very closely to see if this changes to red. The other area we want to highlight here is just deteriorating sentiment. So
a lot of lights on the dashboard are starting to blink and go yellow.
Exactly. So the soft data, so that's the survey data, has been very poor. So not only do publicly traded retail companies' earnings report continue to flag caution amongst lower income cohorts, confidence across businesses and consumers continues to fall sharply. And in the past, this has been correlated on the chart on the far right to consumption expenditures. So it's pretty clear that consumers and businesses are becoming worried about the breadth of uncertainty from tariffs and the impact that they could have on the economy. And this may ultimately force increased precautionary savings and lower consumption, which could feed into lower growth. So this is something we want to highlight. It hasn't come through in the hard data yet, but the survey data, the more advanced soft data, is indicating quite a bit of deteriorating sentiment. And so we looked at the U.S. picture. Again, there's, as Darren mentioned, a lot of lights on our dashboard are flashing yellow at this time. And a lot of it is from the uncertainty and overhang of tariffs. When we move now to Canada, we were relatively spared from Trump's tariff massacre. This was not entirely unexpected to us because we'd long thought that in the Canadian context, tariffs were being utilized as a means to renegotiate USMCA and really were not sustainable given the integration of our Canadian and U.S. economies. Nevertheless, though, the uncertainty from tariffs, the global sector-specific tariffs, do continue to provide a meaningful overhang on the Canadian economy. Unemployment is expected to continue to rise in Canada. We had a negative reading in March, and hiring intentions on the chart on the far right do indicate some further declines ahead. And when we look at the inflation backdrop in Canada, we did expect inflation to remain close to target, and it has. The Canadian economy has slowed, and so that's reinforced the decline in inflation. And a fall in interest rates over the last few months has alleviated shelter costs. Again, we still need to be cognizant of risks from tariffs and one-time price increases to the inflation picture to the extent that they do feed through, which will evolve over the coming months. And we're also aware that Canada is still a relatively open economy, so we are reliant on global growth. So if that's impacted from tariff-related disruptions to other economies, it eventually will feed through to Canada, even if those tariffs are not direct. So again, Canada, like the U.S., we still are seeing some negative downside risks to the growth picture. The other area we wanted to touch on, and as a last note here, was on the Canadian dollars and our policy
Very
expectations.
important.
So, our expectations coming into the year were that interest rate differentials would work negatively against Canada, who would be forced to cut sooner and more aggressively than the Fed. We've seen that to date, and we do expect further cuts in Canada to support economic activity. Most projections indicate another 2 to 325 basis points cuts, takes the terminal rate around 2%.
Yeah, and
Uh,
just sorry to interrupt, just to make sure everyone's on the same page with that. What that interest rate differential and how it works with exchange rates is that Canada and the U.S. are kind of locked in a bit of a dance, right? So if Canada lowers interest rates more than the U.S. does because our economy needs it, then our dollar is going to pay the price of that because foreign investors won't buy our dollar. If we can raise interest rates or keep them higher relative to the United States, our dollar tends to go up. So Canada's in a really tricky spot because in some ways we want our dollar to go down as an exporting nation, although tariffs will change some of the value of doing that. But we also, as consumers, we're generally not exporters, we're importers. So a weakening Canadian dollar generally makes life vastly more expensive for the average Canadian. So it's like another form of taxation, if you will, to what it does to our personal cash flows. So where our dollar goes and where our interest rate flexibility is really material for us to watch, and especially for our clients, where so many of them have money and family in both countries. This relationship is one we really are sensitive to.
yeah. And what's really interesting with our relationship, Darren, is it's through the first 3 months of the year, it worked in its conventional sense, and we saw
Yeah.
significant weakness in the Canadian dollar. But recent strength in the Canadian dollar has not come from these conventional drivers like
Right.
interest rate differentials, but it's really come from a weakness in the US dollar, from a retreat of capital from the US.
Yeah, we didn't get stronger, but globally people said, maybe I don't, that isn't the best house on the street anymore.
Yeah. So, what's really not been talked about, I think, enough by US politicians and pundits is that from the US operating a trade deficit with the world for all these years, the US was effectively providing capital, surplus capital, to other nations that has then largely been recycled through investment into the US. And this is supported by a capital account surplus, which offsets the current account deficit that they were running. So they were importing far more than they were exporting. So now, with some of this capital being unwound, we have seen significant weakness in the US dollar relative to global currencies. For the time being, we're expecting this relationship to remain relatively range bound, and we're going to be monitoring this very closely to see if there's a more durable inflection point in the Canadian dollar or de-dollarization globally.
Yeah. And I think also, too, the outcome of the Canadian election will also move that needle a little bit in terms of whichever party or however we do this. If we get a majority, get another minority, global investors will have a perspective and they will vote with they can't vote at the ballot box, but they will vote with their dollars. So we'll have to see how that unfolds.
And as a finale to our Q1 update here, we just want to talk about dealing with uncertainty, because if you've taken anything from our comments earlier, uncertainty is going to remain pervasive through the next few months here because of the economic uncertainty and the tariff-related backdrop, which hopefully we get some resolution on as the year goes on. But certainly uncertainty is the word du jour and will be for the next few weeks. So how do we deal with this uncertainty? Well, the first thing I wanted to contextualize here is that declines in the U.S. equity markets are not uncommon. So let's just take that as a ground base. I know no one likes to see it, and we've talked about how we're being active in mitigating these risks and declines, but the reality is that these declines will happen. So we have a 10%.
The money is not on an escalator. It doesn't work like that. And everyone who's been investing understands that these drops and things are part of the deal. It's kind of baked in the cake. The amount that it happens, I think, surprises people, because I don't want people opening their statements every day or every month. I'd rather them just ignore them. But the frequency which volatility exists, it's good we remind people just what the ride looks like.
Yeah, and we can see here a decline of 15% or more happens about once every 3 years, 20% or more once every 6 years. We've seen substantial declines very briefly in March of 2020 and a V-shaped recovery. We saw a more prolonged decline in 2022, but again, a pretty substantial recovery the last 2 years thereafter. So these are not an uncommon feature of financial markets. We know it can be a little distressing. But again, as we've spoken to, we need to contextualize this in the long run picture. So the price you pay for long-term performance is short-term volatility.
Yeah, I
And
liken this to weather, right? Like this is
yeah,
weather, and some countries have more volatility in their weather, others have less. If you move to Canada from a country that was perennially warm, like Guyana, Bermuda, or something like that, the first time you experienced February in Halifax or Winnipeg or Calgary would freak you out because you didn't know this was possible. But for Canadians, this is just we know February is cold and August is usually warm. So in April, like now, you might get anything. It snowed the other day. So this is just the weather pattern for investing. Now, the one thing that I would say is perennial is this constant erosion of purchasing power. So I know people don't like market volatility. They don't like risk from the perspective of risk to their dollar. But I would argue that for everybody watching this who's an adult, the one constant in your life is the erosion of purchasing power. Everything is always getting relentlessly more expensive. Every action governments are taking is print more money, spend more money, tax more money, and lower the value of your money. So you can't, no one has the luxury to go and sit in cash or GICs or bonds for a long time, unless you got a huge amount of cash and you don't care, because your money has to work. And so from my perspective, it's not about protecting your dollar from volatility. It's protecting what a dollar buys. And that's really at the heart of everything we do. There's no getting off this ride ever. Sorry.
yeah, great point there. And if the chart illustrates exactly that, and it's that you want to stay invested, you want to look to the long term, you want to look to your goals, and we can see over the long run, U.S. equity markets have continued to provide positive returns for investors and protect their capital. And we're staying diversified, and we're continuing to source opportunity where we see a positive risk and reward trade-off. And as a final chart here, we've had a lot of comments about timing the markets and what to do with new cash and how we deal around those circumstances. And really, I just wanted to reiterate, timing the market is a very difficult endeavor. And you can see the value destruction if you miss just the 10 best days, best 20 days, best 30 days, etc., from being out of the market. And the reality is a lot of those days come right after the market has gone down.
Yes.
So it's very difficult for investors to kind of get their head around putting capital to work when the market is down because they often want to put it to work when the market is going really well and the prices are either high. You see that on the chart on the right.
Investors buys high and sells low. It's the exact opposite of what we're supposed to do. Actually, Pedro was just commenting before we started this. For some new clients, we really like to usually tranche into portfolios. We don't just throw it all in one shot. We like to kind of spread it over a period of time just to get the volatility to kind of work for us. And he said, if some of the money we're allocating right now because markets are down, he goes, in 2 years, I'm going to look like a genius. I said, you go, girl. So that's great. But you're right. You can't really time any of this stuff. Our function is to try to see where relative benefits in terms of something's a little too expensive or something's a little less expensive and rotate accordingly. But to just go right out and try to sit out the inning, it's not possible. And as we can see, all the data and charts tell us that if you want to go to the sidelines, you're going to miss things. And you're exactly right. The biggest up days in markets, the ones that are materially important for you to benefit from, come after bad days. And so if you're trying to time this, it's a fruitless exercise. And anyone who's ever tried it, well, you don't know anyone who's doing it because no one has. So the right thing is you got to just, as I said earlier, you got to keep your head and arms inside the ride at all times. And you got to take the downs, try not to make them permanent by buying junk. If we buy quality and stay diversified, we always live to fight another day.
Yeah, we make that ride a little more comfortable, certainly, we hope. But as you said, remaining diversified, we try to take advantage of volatility, and we've been rotating and allocating capital where we think there's the best risk-reward trade-off across our portfolios. And we're continuing to do that. We're continuing to try to source opportunity amongst all this uncertainty. And so that is the end of our presentation for Q1. So thanks, everyone, for staying with us.
And Aaron, you've got to do some shopping because you got this nice new office, and I can see you haven't got your television up yet. So that'll happen. We're all still moving in. All the furniture.
It'll be here by the next quarterly video.
Okay. Well, listen, Christian, thank you very much. That's always a really good refresh, and I appreciate you always kind of scanning and finding us, I think, the most interesting charts and pieces of data. I know there's thousands you could use, so thanks for finding the ones that are the most illustrative. And for you, those of you watching, thank you very much for sticking with us through half an hour of these things. Any questions, always reach out to the team. We're happy to talk and share what we're thinking, what we're doing. So, and we'd love to hear from you. So, Christian, thank you very much. And for everyone else, we'll be here. So keep watching, and if things change, we'll change.
Yep.
Thank you.
Thanks, everyone.